Steen's the chief economist and or chief investment officer, or maybe both, at Saxo Bank, or maybe those were two different titles. He's worked everywhere, so I won't go over the list. But he's also on Twitter, and he also adds a lot of valuable 140 character remarks on Twitter if you want to follow him there. But he's also got a great blog, I guess I would call it, on tradingview.com. Is that right? Tradingfloor.com. And then you can kind of find, it's a bunch of different people, but you can find Steen on there, and his stuff's great. And of course, Mish will regularly post some of his stuff as well. So without further ado, we'll have Steen take it away. Your mic should be good, and your clicker. Thanks.
Thank you. Again, it's a great pleasure being here. I'm not too happy about the scheduling. Talking just after lunch is probably the second worst time to speak. And I'm reminded of the great French inventor Pasteur, who once said that there are more wisdom in a glass of wine than in all of the world's books. So I guess we're in the right place. I feel like I'm the one optimist here in the crowd. And actually, normally when I start my presentation, I have to make excuses for my reputation, which is, as I think I indicated yesterday, that I've predicted no less than 5 of the last 2 crises. Takes a little time to understand the joke. Even in the US, it seems. And normally my CEO introduces me as someone who, he says, does not believe that the glass is half empty, who doesn't think the glass is half full, but actually thinks the glass has been stolen. Which actually is pretty much what you guys seems to be thinking. Everything has been stolen away from you, your future, your opportunity. So let me start by being the most optimistic speaker you're going to have probably this year today. I am the most optimistic I've been in 30 years. For no other reason than it can't get any worse. I think we have the worst political setup. I think we have had the biggest political experiment, the biggest monetary experiment. And I think to some extent, and let me say this with a smile, all this morning and yesterday has been historic lessons. I mean, I'm all for historic lessons, but you are not really trying to look forward, are you, ladies and gentlemen? You are all sort of looking at Cape backwards. You are talking about continuation of prices. You want to believe that the world is going under. So, you know, the way I like to phrase it is that you are all basically, just after this session, going back to the internet, looking up when is the Noah's Ark going to sail out of town, right? You're trying to book this ticket for eternal breakdowns. And don't make no mistakes, although I'm the most optimistic I've been in 30 years, I do believe we need a breaking point first. I think if you look at the evolution of the financial market, it needs to break down before it gets to a better place. And that is almost exclusively driven by the dogmatic central banks, but also certainly politicians who are unaccountable. So the way to make them accountable is actually to have the system break down. And that actually leads me to my picture here, which has created some sort of raised eyebrows when I go around the world with what the hell is this, basically. The beauty is, of course, that it's everything. This is the cabinet meeting, or the Obama calling in his advisors on Russia. He's singing. It could also be the EU ECB council ministers trying to figure out how to do quantitative easing. Could certainly be the Bank of Japan. What the hell is going on? We've spent so much money and we're going absolutely nowhere. So I think the world is in a state of flux. And I think the confusion and the wasted time we had on looking at CAPE and all these things, which, you know, to be totally honest, is very, very good. And I understand. And I'm certainly with John on mean reversion. If anything, the only thing I really believe is in mean reversion. From black to white, from cold to hot. I think even probably our sex lives are mean reverting, unfortunately. Well, that's struck a tone, huh? I think that I'll make it very simple, because I'm a simple guy. Although I come from primarily a mathematical background, I'll give you, and take this presentation this way. I think the most important thing I'm going to teach you today is this, and it's very simple. The interest rate leads the economy by 9 months. So the only history lesson you ever need to do is to ignore today's news and look at what happened 9 months ago. What happened 9 months ago is that we have just started the tapering. So the reason why we have a slowdown, 0.1% growth in the US in Q1, is that the tapering happened and started in May last year. It's not because of the weather. Of course, the weather is 20-25% of the slowdown. But you cannot raise interest rates by almost 100% in the short end and not get a reflection to happen or a functioning, or a result to happen in the mortgage market and in every single marginal decision being taken in the world. And that's why I think you as stock market operators, as commentators are doing wrong. You always want to look at the momentum, but you really only want to look at the marginal changes. The only thing that matters in the world is marginal changes. When your children goes off Facebook and goes to Twitter, that is significant. It is not the amount of members using Facebook that's important. It is the marginal increase in new memberships. That's also why when you have the traditional chart of the the balance sheet of the Federal Reserve and the stock market, you probably noticed it's starting to sort of go apart now. Well, it hasn't really, because since May of last year, what you need to do is to look at the percentage change of the Federal Reserve balance sheet. And that is falling, of course, relatively speaking. That is the reason why the stock market is starting to have, problems, is continuing to go higher. The other thing which is pretty shocking from most momentum and valuation-based stock market pickers is that the stock market actually lags the real economy by 3 months. So whatever goes on today will not be reflected until 3 months from now. So the pricing you have in the stock market right now is based on the optimism you may all remember we all had in January, to your frustration, I'm sure. But at least you've been proven right in terms of the macro side, but yet to see the results. But I think it ties really well into, I think Meb was mentioning the election cycle, the go away in May, all these, to my opinion, totally nonsense way of looking at the market, because I don't really believe in that history repeats itself. I think there is a huge micro change to the underforest of economic indicators every single day. And that's where I deviate from 98% of all you guys. Because remember, let me just go back one second. So basically, this is the inverted 30-year rate, mortgage rates, and new private housing units. It is totally logical that housing cannot contribute to GDP anymore. If you increase the funding cost, the marginal cost of refinancing, it has to drop, right? Supply and demand. I mean, at least we have that part of the global economic markets left. So that is totally natural. What's also natural is that we have a massive flattening of the yield curve. I mean, and it's one thing I learned in school, almost 35 years ago. It was that yield curve is actually probably, everything being equal, is the best predictor of future growth. And right now it's indicating, and this is the Cleveland Fed, not my projection, that, hang on a minute, they didn't like me presenting my presentation too much, huh? There we go. So basically, if you look at the Cleveland Fed, and this is on the front page of their website, it's actually indicating growth in the US will go to 0. That is not my prediction, that is the Federal Reserve Cleveland's prediction based on yield curves. The other irony, and that is important to notice, and that goes back to my first point, what happened 9 months ago. This is probably very difficult to see at the back row, but I'll tell you what it is. It is the 1-year GDP-weighted index of the 10 biggest economies in the world. So basically, it is the 1-year rate, the steering rate for the 10 biggest economies in the world. And that, my ladies and gentlemen, is up 100%. So although the central banks continue to tell you that interest rate will be maintained lower for longer, the actual thing that's going on in the marketplace is that short rates is going up, which by itself dictates that forward guidance is not working. Forward guidance is the exercise talking to the market and giving you your predictions on what will happen, future potential path. But the market is telling you, screw you, because short-term interest rate is up by 50 basis points from 0.5% to 1%. And what's even more ironic is that Yellen doesn't even believe in their own models anymore. This is the front page from Bloomberg News, that the models Fed uses is actually not able to capture inflation. And I think that is kind of a very brave and admitting that is going to be, you know, coming back to roost for her. It just reminds me of one of the greatest quotes that I ever heard. I think it's from Dylan Grease, who said, it's kind of interesting that the monetary policies construct we have of the world is we are trying to measure something we can't measure, inflation, and we are trying to do it with something we don't understand, monetary policy. So there's a reason why we're all confused. There's also a reason why this year you can, and I will argue, you can be an inflationist and you can be a deflationist at the same time. Because the monetary policy is truly inflationary, but the actual economy is deflationary. So it's very easy to be both. And if you look if you trade, you have to be very aware whether you are part of the economy that is deflationary or inflationary, because you can have both at the same time. Similar as we saw in the jobless report this morning, you can also have two labor markets. You now have a labor market where people are never going to work again. I guarantee you the lowest 5% unemployed in the US is never going to work in their lifetime, due to demographics, due to the inability to create productivity and other things. On the other hand, as I think, who was showing that yesterday? Someone was showing that Alex actually was showing yesterday, the marginal pricing power of the people who are in jobs is going to increase. It's also ironically increasing in Japan, in Germany, everywhere. So we have two jobless queues. We also have the fact that more and more people is living in the cities. So when I go to Spain, and I go to 30 countries on average a year, and I tell you the most optimistic place I've been to this year so far is Spain and Madrid. But the problem is when I go to Madrid, I'm only talking to the economy and the economists and these bankers that are placed in Madrid, the biggest city in Spain. You can go literally less than 100 kilometers outside Madrid, and you will find empty cities, airports that's never been used, and roads that's never been driven on by anyone. So we have this bifurcation of the economies in the cities and outside the cities. The problem is they all add up to a country. So Spain is still in this shit, but it's not being reflected by the prices. So the first thing I will give you is that we don't use linear integration. We don't even actually believe too much in the past. But what we do believe is something called economic physics. So you're really applying engineering math to economics. You are using the laws of displacement of objects if you're an engineer, which give you the ability to measure and deal with cyclicality, leads and lags. And when we look at our leads and lag model for the US GDP, as this model is showing, and let's make the conclusion first, we think the low point in this cycle for GDP, for inflation expectation, will be in Q4 and Q1 of next year. So I am actually truly saying I think it can't get any worse. I think 14 will be the worst in terms of the economic environment. But I also think, unlike 98% of you, that already next year, as we exit 2015, we will both have the inflation expectation through the roof. We will also have growth, and it will be probably the bestest bull market we're ever going to see. But let me take you back here. So we don't believe in one single factor explaining anything. We actually don't believe that you can do any leading indicator based on just one factor. So we use 25 different economic vectors. And what's significant about 2014 is that out of those 25, 22 of them goes down in 2014. 20 of them bottoms out in 2014. Which means the good news is it gets worse first, but then it gets much, much better. We have a true low in terms of our forward. That was a Twitter. The true low in 2014, end of 2014, early into 2015. And this is like Missy's telling me, everybody's saying, oh, it will take at least 3 to 5 years. Yes, because you're a linear thinking people. You use the last 2 days of information and you extrapolate them into the future and you make the classic mistakes. This morning I read just about any investment bank's comment on the unemployment rate, and none of them commented on the fact that 800,000 people left the working force. I mean, it's kind of interesting. You know, it was at the same time, it was the best number since Stephanie helped me, since 1985 in terms of the number of whatever, the unemployment rate. And it was also the worst since 1978 in terms of people leaving. Come on, let's stop looking at this nonsense number. I mean, the mathematical correction of the number is almost 50% of the total number. And I don't know why we even believe it. Even the Federal Reserve is telling you threshold in terms of employment doesn't matter anymore. But I'm actually very positive. So my biggest call since Q3 of last year has been, I am 70% long fixed income. There is no way in hell the world will survive if interest rate goes up. So Yellen can want and think what she wants, but there's no way that the world can carry rates higher. There's not even an ability to get growth in the world because the demographics, the productivity cycle, and everything else is also negative. So I think we will have, I believe our model is indicating that pretty much, I'm no good here. We are by the time now about here, we think we will go to new lows in interest rate. This is 10-year, just as a benchmark. But we think across the board, the longer duration you can have, the better. The world, and my argument is pretty simple in terms of fixed income. You can have an expected return on the stock market of up 10% at the best with a downside of 30, in my opinion, in 1 year expected return. And in bonds, you're going to have 2% plus another 1 to 2% in terms of the price you buy it at. I mean, market is way underweight fixed income. And let me just put a nail through the argument, money on the sideline and global rotation. Come on, ladies and gentlemen, you're intelligent people. Many of you have taken degrees in math and everything else. It can't happen. I mean, there's no way in hell you can get money from the sideline into the fixed income or from fixed income to equity. Actually, every single day we are issuing more debt, making the size of the fixed income market deviate significantly from the size of the equity market. The equity market, on the other hand, is buying back stocks, reducing the float, and that way making the earnings per share go up. 50% of the earnings per share last year in the US S&P 500 was from buybacks. So there isn't any great rotation. It can never happen because if someone sells a bond, it creates a cash, right? Someone else takes over the position. And what is even more interesting is that we are still talking like the tapering is a big deal. But in Germany, we are 1.5 points away from being at the same level we were in May last year. That is an indication of something. What is it an indication of? It's an indication of deflation and no growth. But this is happening. The bond market is telling you, while the rest of the world, including this morning every single commentator I ever heard of, that growth in the US will be 3.5% and Germany will be 3%. But why in the hell is the biggest market in the world telling you the opposite? So 2014 to me is this year where we have a lot of conflicting trends. We have a lot of micro improvement underneath, but we haven't been able to actually take it to the front line. And this is the expectation of CPI in the US. And as clearly, we have a deflationary scare first. And I think the biggest policy mistake that will be done in this cycle will be the ECB fighting deflation in Europe and the Federal Reserve stopping the tapering. And I agree totally with Stephanie. They will taper the taper before it runs out. But that will be a mistake because exactly when they're trying to fight deflation will be the time when structural inflation starts to go up. Because the margin of pricing power in employment is going up at the top rank of employment. But at the same time, the deflationary forces of what's going on in China is going the other way. Because don't forget, the unit labor cost in China is increasing significantly. Actually, the biggest part why you have job improvement in the US in real terms is reshoring. And that leads me to another point. I mean, I know Axel and I had a small disagreement on China yesterday, but if I'm certain about one thing, it is the fact that the rebalancing that goes on in China is exactly the reason why the world is going to slow down significantly in 2014. A few facts. The US current account deficit has halved over the cycle of this crisis. The only reason you have an export sector in Asia is the US current account deficit. You guys have spent so much money, and I thank you from the bottom of my heart. You've continued to spend more money than you ever had for so long, because you created this huge gap that needs to be filled with rubbish Chinese goods. That has now been reduced to half, which means when you sit in a Chinese company as a CEO, all of a sudden you have half the ability, half your market has disappeared. At the same time, your unit labor cost is coming through the factory floor and up into the ceiling, and you have increased tension in terms of your ability on your currency side to do anything. So China, over the next 3 to 6 months, will be inflationary. But their response, and remember, and the reason why Axel is Axel is wrong is that China is a closed economy. The only way you can conduct easing of monetary policy without reducing interest rates is what? To devalue your currency. So China will devalue, and by devaluing, they will re-emerge as a deflationary force. But inflation will be coming first and putting the pressure on the other side. And then let's just take this job report, which is absolutely nonsense. The only thing you need to look at is employment relatively to population, and it's gone nowhere in the last 8 years. So yes, you are back at having the same amount of jobs you had in 2007, but unfortunately you're what, 20, 25 million more people. And I think it's pretty telling. I've been in San Francisco for like 2 days, but everybody I ever met, my taxi driver was from Bulgaria. The person I met at the coffee shop was from Vietnam. I mean, every single person I met is an immigrant inside the last 5 years. It's sort of telling that the increase of jobs is not happening, because if they are still coming here to take the jobs you don't want, you have a problem, a luxury problem in a sense, but you have a problem which is very, very telling, and it is across the globe issue. I don't know, I'm an economist by training, but this is by far the most sexiest chart you're ever going to see. It is almost as good as sex, I promise you. And the reason is it tells you everything on where we are in the crisis, how we got into the crisis, and why you should not invest in certain countries. So let's make 2000, sorry, I'm very not good at this. 2009, forget that, and look before and after 2009. So before 2009, the big countries ran a 5% current account surplus. Today, and this is IMF numbers, so they're at least 2% too high, it's flat. So the BRICS country during this crisis has gone from being one of the most competitive, the production hub of the world, to being uncompetitive. Inside the BRIC countries, Brazil has gone from a surplus to a massive deficit. China has gone from a massive surplus to barely a surplus. India has gone nowhere. Russia's gone from 10% surplus of GDP to negative this year. And you have South Africa, which is just a basket case. So the BRIC countries, which every single company I ever meet, every CIO, CEO I meet, is always talking about strategy, the growing middle class. But it's all bullshit, ladies and gentlemen. Because, you know, they're not going to be buying bicycles. They're not going to be buying any American products if they can produce it at home. And what people misinterpret China is that China is consolidating power. And the cycle in China is 10 years. The first 5 years, you inherit 50% of the old cabinet, and you have to deal with them. In the final 5 years, you can actually do something, because then you get all your people at the high level. So the improvement, if it comes in China, will be 4 years down the road, because the changes that happened in China happened, say, 12 months ago in November. The other thing here is that if these countries are losing competitive, someone else is gaining it, right? Because the big beauty is, which eludes a lot of economists, by the way, is the fact that current account surpluses goes to a big fat zero, which is, being a European, is kind of ironic, because Germany seems to think that everybody can run a trade surplus, which is impossible. Someone needs to buy your shit, right? So the ones that benefit for this is the US. The US has, as I said, benefited massively, not because you were smart, actually, but merely because your oil production has increased. So you shouldn't be patting yourself on the shoulder too much just now. It's just merely the fact that someone figured out the shale gas was a great investment and lowering the energy cost. And going back to Chris's point yesterday, that's actually behind, in my opinion. I mean, the shale gas contribution to GDP was in 2012 about 0.8%. And by the way, I forgot one important point on the housing market. The consensus this year is that housing will contribute 0.5 to 0.8% to GDP. But every single number you've seen so far is down 25%. So that's another irony of math. Then we have red alert, 25th anniversary for the Berlin Wall. And here I have to make a very strong political statement. I think it is totally ironic and funny that this is the 25th anniversary of the Berlin Wall coming down. So exactly 25 years ago, we were in the streets celebrating that the market-based economy won over the planned economy. Fast forward 25 years, and we have the Soviet Union of the United States. We have never had a bigger planned economy in the world. We never reduced ourselves to more central planning, macro policy ever in history. The Harvard School of Business, sorry if anyone attended Harvard here, has ruined the world. Doing more fiscal deficit, believing that buying time is the solution to everything, is going to be shown to be wrong. And it's showing up. Already the CDS of China is higher than Ireland, which is pretty impressive in itself. And of course, Russian debt and risk is up significantly. This is the second most interesting chart. This is what I talked about yesterday in the panel, total factor productivity. This is the mature economies. This is the US. You actually have negative contribution from productivity. So you may think that Apple is the greatest invention ever, but it's actually doing nothing for your productivity, which sort of makes sense to me, you know, that your kids spends more time on Facebook and on Apple, on apps. It's not making them smarter and certainly not making them more productive. So we have not created anything since the fridge basically was invented in terms of innovation. And what happened and what carried the world through this early part of this crisis was this huge improvement in productivity in the Asian market. That productivity was almost exclusively driven by total fixed investments. And who benefits the most from total fixed investments? The US, Germany, Switzerland, Denmark, France. So now the Asia is rebalancing due to the smaller export market they have in the US, firstly. Secondly, because domestically they need to create more jobs. So as they rebalance, going from top-line growth to quality growth, going from the franchise model of having McDonald's to investing in education, ports, railway system, infrastructure, long-term investments, they are reducing their capability of creating growth, again becoming a deflationary force. And the reason they're doing it is not because, and that is the lesson we need to learn, they're not doing it because they want to, they're doing it because they need to. And that is my premise number one. Any change that's ever happened to your personal life, any change that ever happened to a politician's life, is almost exclusively driven by them failing or getting the back up against the wall. And I think 2014 is that year. I think it is the year where we came into the year with very high expectation recovery. We were barely 2 weeks into January before IMF, the ECB, World Bank was increasing world growth projections. The US GDP started with an expected rate of 2.9%. Let me remind you, it came in at 0.1. And that's actually against the base in Q4 that went from, what, 4.5 to 2.8? So it's almost impossible not to beat Q4 on a quarter over quarter. And this is one of the reasons why. Demographics, productivity is carrying us down. And I have a problem with this topic of recovery, because to me, recovery is when you are back at where you used to be and you're moving forward, right? I like to say that it's like buying a stock at $100, it goes to 10, and the next year it goes to 11. Is it then down 89% or up 10? Well, if you're a financial news service, it's up 10, of course. And if you're Italian, it's up 100. Deflation. So ECB keeps telling us inflation is transitory. They keep telling us it's something that we can see through. The problem is that since I produced this chart, another 3 countries actually were moved into deflation. So the ECB is caught at zero bound with no alternative. There is no ability, there is no prescription. They can't do a full quantitative easing, although you would want it if you're along the stock market, because there isn't an ability to GDP weighted going in buying 28 countries' debt. And by the way, these countries have very different ratios of debt. Of course, the Italians can provide plenty of debt we can buy, but the Danes, barely able to do it. So one of my outrageous predictions this year is actually Germany moves to recession by Q4, which I'm not getting very popular with when I carry this presentation into Germany. This one you need to be aware of. In May 24th, we have European parliamentary election. And normally it wouldn't matter, because who cares who gets voted into the European Parliament. But this year, the anti-EU vote is leading significantly. Actually, right now, the anti-EU party is more than the majority in the European Parliament. And what's happening in Europe is that gradually they have transferred power from what is called the Council of Ministers, or the Prime Ministers and Presidents, into the European Parliament. So it actually will have an impact. It will certainly slow down this banking union we all talk about. It will certainly slow down. The irony, and this is a lesson for the US of this, is that the reasons why that the anti-EU vote is gaining is that welfare tourism. So in Europe, we have just added Bulgaria to the European Union. So a Bulgarian unemployed person can move to Denmark and the next day get all the social benefits of the Danish system. And let me put it this way, if you get social benefits in Denmark, that equates to being the top 1% richest person in Bulgaria. So you can imagine the transfer of income underneath this is significant. Just on Japan, I want to show you one chart because I think it came up a couple of times. This is present condition versus future expectations. At the bottom of the stock market in March 2009, the Japanese actually thought that tomorrow would be better than today. Fast forward to today, the Japanese are the most negative they've ever been. So either they're very smart or very ignorant, because they are basically telling Abe, we don't care what you think. We are certain that this experiment is not going to work. It is also, by the way, either the best inverse indicator ever in history to buy Nikkei. Nikkei could, on this chart alone, be the best buy in relative value you're going to see. Which means that actually another probability we have, we think dollar yen is going to 90, which is going to disappoint a lot of carry people in the world. And we think, you know, every single speaker in Europe been talking about the euro going down this year for the last 5 years. I think this year is the year where the euro goes down because they have to ease. They are behind the curve. They have a relatively tight monetary policy. And then we have an equity cycle, and that actually goes quite well with John's mean reversion. We think there is a 30% correction in the stock market embedded this year, but if we have any ability to call it, it will be in the second half, not in the first half. We actually think if we taper the tapering, there will be a positive sort of momentum based on that, and that will be your signal to exit the market. So I hope I lived up to the true definition of an economist, which is someone who tomorrow will be able to tell you why the prediction made yesterday was wrong today. Thank you.
Well, I don't know about everyone else, but I could listen to that voice all day, even if the message is totally antithesis of mine. Enjoyed it. I guess if I understand correctly, you're saying that because things are so bad, the central banks all around the world are going to have to redouble their efforts, and that's going to put a floor under asset prices after an initial correction. Do I understand that correctly? You seem to say there was a 30% downside possibility between now and the end of the year.
The setup is right, it's just the timing is a little different. So what I'm saying is that I believe that first we taper the tapering. That creates sort of a retest of new highs, which partly is happening already because, like, despite the numbers today, treasury yields is again coming down. So we are really repricing, in my opinion, the bond market certainly repricing the extent of and the length of the tapering. That can create, you know, potentially a new high, or we can have a directly 30% correction. So I'm not saying that I agree that they will try to do more, but I think this time we will call, the market will blink because short-term interest rate will continue to go up despite doubling in Japan. And I don't think they even try to do it because I think Yellen is very aware that doing QE, the biggest problem she has with that is inequality increases by it. And she cannot continue to condone inequality. And that is the reason why I think quantity is losing its traction socially and practically. So it will be a last attempt, but it will fail, and that will create the 30% correction. And then what comes in from underneath is this cyclical structural improvement that happens in global trade, in competitiveness of the US and Europe. So we are far more balanced in the current account way, and I think that would already start to play in Q1 of next year, and then we'll see things go. And what will drive it is primarily lending will start to come back. So you increase the velocity of money, increase inflation expectation, a little bit more transparency in terms of what goes on.
Okay. I guess that kind of plays into my other question, which was I totally have sympathy for the deflationary overtones and the idea that you want to own treasuries. When it comes to the rest of the fixed income market, I'm interested in maybe you could give us a little more nuanced view on that, because it sounds like given all the slides you went through, which are almost more depressing than the stuff I went through, I would think you'd expect treasury yields might rally, but corporate spreads might widen out, and that would act as a further damper on economic activity in general and maybe equity prices.
I agree with the premise, but I agree with the consequence. I actually think it would be great if we took money out of corporates. I have this theory that 20% of the economy, which is the listed company and people with access to this credit, the credit market, takes 100% of the credit availability there is in the system. So I want the 80% to have access. And the only way you can transfer from the corporate credit and the people with access and getting it too cheaply, according to John, is through instigating that the SME sector primarily gets access to this funding. So I think it's a great sign of strength if the corporate spread goes up. And another point on the corporate spread is that I'm on an advisory for a credit hedge fund in Europe, a very successful one, despite me being on it. And they last year on Friday did a presentation to a family office, and they came in not wanting to pitch anything because they have too much money under management and they couldn't take any more and they can't put it to work. So they did this whole spiel that you right now should be looking not at past returns, but you should be looking at absolute risk and everything else. And the conversation ends by these guys giving them 50 million Swiss. So that tells you that the allocators right now is so desperate to get into exactly that segment that is overdone. Same afternoon, we have a meeting with from the passive part of our business, where this is fixed income, of course. So we wanted to buy a fixed income mandate, and they offered us the mandate at 8 basis points. So the market is totally screwed up in terms of what it does. And that goes to my first point, which is that's good. Because if it's only worth 8 basis points or you can get money in a product you don't want to have money, it actually indicates that we are at the end of a cycle. And that cycle needs to go and sift through into the local markets, the SME sectors and everything else. So I think there's a big transmission going on that takes care of this. I think if you want to make 15% return over the next 2 to 3 years, you need to engage SMEs. You need to be facilitating the one big gap there is in the financial market, the credit intermediation factor. And it's not going to be corporate bonds, because that is the lazy way to do stuff like that.
Okay. Just one final question. You were fairly negative on the outlook for housing. How does that play into your outlook for lending picking up as relates to hits to the banking system that decline in home prices might result in?
So first, lending goes up in terms of getting the local business person the access, and then the housing comes up. I'm not necessarily negative. I'm just pointing out that the consensus contribution from housing is 0.5 to 0.8, and that's nowhere in hell is going to happen. It's going to be a negative. But I actually think, as you indicate correctly by your question, that cyclically 9 months from now when interest rate is down, using my first chart, 9 months from when interest rate is coming down, and they are coming down, we'll see an improvement in the housing market. If there's one correlation that does work in my model, is actually the fact that the mortgage rates, fast forward that 9 months, and you see whatever net change that happened 9 months ago will come in positively or negatively relatively.
Okay, questions?
Yes, how does the Abenomics play out, and what does that do to the yen and intermediate and long term, the yen versus the Nikkei? What happens there?
First of all, the Abenomics has never been about getting dollar yen to 130, and that is a clear misinterpretation. Abe is a nationalist. He wants to change the American, it could just as well be, the Japanese constitution. You're probably aware that the Japanese constitution is written by American, right? It's written by General MacArthur, basically, or his staff, and he wants to get away with it. And I would do the same if I was Japanese, to be honest. I wouldn't want no disrespect to Americans, but I would want a Japanese version of my own constitution. So everything he's ever done is to create the popularity to execute the 2/3 majority to get to the changing of the constitution. And if you took that perspective and go to your question, Mish, then he's already failing and failing miserably, and he will fail to get that majority to change it, which is kind of sad, because I think it's okay to change the constitution somewhat. I mean, clearly Japan is under attack from China. I mean, anyone who's ever been to China will tell you that it's very, very hard not to feel the hate they have from the Japanese, even from a 5-year-old all the way to a 90-year-old. And that, again, is misinterpreted, certainly over here. But it will play out like that dollar yen will go to 90, 92, They will double the effort trying to do more, and they will fail. But don't forget that, and this is an interesting anecdote. So I wrote a piece a couple of years ago about Japanization. And then I get a call from NHK, which is the equivalent of the BBC in Japan. They want to send a TV reporting team over to interview me because they didn't understand this Japanization. So they came over 5-man high, interpreters and everything. Mr. Jakobsen, why do you say that Japanization is negative? We don't feel poor. And it was kind of an interesting question because the Japanese don't feel poor. And the very thing the Japanese wants is what? Deflation. Mm-hmm. When you have bad demographics, when you have an Asian population with net savings, the last thing you want in the world is inflation. When you have a public debt of 240% of GDP, what is the last thing you want is rising interest rates. So by definition, the path of least resistance is low interest rate and no changes. And that is why inside the next 1 to 2 years, Sony will go bankrupt. And Sony going bankrupt will be the biggest buy signal you're ever going to have from Nikkei. So wait for the failing, and then you can buy dollar yen all you want, but everyone. And I go to 30 countries, as I kept telling you. I've yet to meet someone who doesn't think dollar yen is going to go to 130. 99.5% of everyone I meet thinks the dollar yen is going to go significantly higher.
Next question. Here.
My opinion, for quite a while, has been I don't think the Fed can change what they're doing. What it seems to me is that they want to hand it off to Draghi. But in your speech, you just said it sounded like it's not possible for him to do like an LSAT program. Can you explain what? Because it seems to me that he said he wants to, or at least he's mouthing the word. But can you explain why he can't do that?
Now I have to come after the Italians again. I'm sorry. Draghi talks a lot like a good Italian, and he likes to promise a lot of things. And Draghi believed, and partly backed by academic papers, that talking about something, the threat of doing something, can do most of the work. Bank of England did a paper on quantitative easing. So when you do quantitative easing, what work? It turns out that 75% of the impact is the announcement. So when you have 100% of the, whatever, I think the calculation in Fed terms is like, is it 50 to 60 basis points, the price of which you reduce the overall interest rate in the US relatively. So 75% of that comes from the announcement. So he's playing on, threatening to come with this. The practicality is that he should be doing SME lending, he should be doing ABSs and whatever, but there isn't a market for it. It's not, as you clearly know, in Europe, 70% of the funding comes through banks, whereas 70% comes through financial market in the US. So it's a very, very, very fragmented market. So what we'll have to do is to do a little bit of intervention, small, 100 billion, 200 billion, but he can never go to a size that matches the expectation of the marketplace, because people simply do not understand that it is not possible to buy GDP-weighted German bonds for them. But what they should do is just to buy the hell out of bonds, because that will get every single fund manager 2 long German bonds, and they will be buying the peripheral. So that would be the exercise that they could actually do, forcing the German rate so low that you as a fund manager will be needing to buy the peripheral to get the extra carry. So
just
that,
like the Fed did here with corporate rates, basically.
Exactly, Stephanie. But that can't happen because that's against the Constitution. So I believe that he will do something, and he will go negative rates, and you probably saw Medley Advisors, which I don't actually give a lot of credit to, but they came out yesterday. They'll go full negative credit. They will announce intention for QE. So they will keep talking, similar to Yellen. Don't forget, forward guidance principle is to talk you into believing something, despite the fact the Federal Reserve is by far the worst predictor of the economy you can find. I mean, even my dog does better prediction on the economy than Fed does.
But you're saying it is definitely against the Constitution, because they've made statements that we can work around.
They cannot buy one market only. They cannot buy German bonds only. They have to do it so they don't finance government debt. So it's I agree, there's a very fine line, but you cannot exclusively buy, which they should effectively buy, Greece or Italian debt. They have to buy unilaterally every single bond. Yeah. So that's why it's so difficult to execute an American-style QE.
I feel bad being the cherry picker, but yes, please, Jim.
I'm curious, Steen, I agree with your idea that we're going to have a big deflationary pulse I'm just trying to understand your sort of step-by-step idea of how like a 30% correction in the stock market wouldn't be this reinforcing feedback loop of deflationary sentiment and dragging asset prices down. How that would act for a longer period of time. It's hard for me to understand that happening and then right away the velocity of money picking up and inflation and lending and all these things picking up. Whereas to me, I would see that maybe happening after a year or two. So can you walk me through why you think it will get so quickly?
I understand your skepticism. I'm also having a hard time sometimes explaining to myself. But first of all, just one practical note. The way we do the forecasting is we let the model talk and then we reverse engineer why, which I think is the only way you can do true modeling to big extent. And having said that, you know, although I would want to be smarter than my model, I have to say every time I deviated from my model and done something else, I've been wrong. So I trust the model more than anything. But the way I see it is, and we are not just dissimilar, I actually think that upping the ante in terms of trying to protect what goes on, taper the tapering, Bank of Japan going, ECB announcing whatever measures, will fail because the traction at zero bound is that it has no impact. I think you said it yourself to some extent in the movie and certainly during dinner last night. So the doing more QE or upping the ante would actually be seen desperate by the market, and that will create the 30% correction. But underneath that, don't forget, you have the improvement in the current account balances around the world. The balance sheet, everything being equal of the corporations are big. They are overvalued as per John and Meb's presentations, truly. But it doesn't take more than 1 month or 2 months of bad markets to get them back to fair value. And all of a sudden, we see Hussman being the most positive guy we find in the marketplace, right? So I think it's very easy. And don't forget, when we come out of a low, we have exponential growth. So if you are able to buy my concept of, you know, all of a sudden there's constituted some lending mechanism similar to what's happening at the Bank of England, where you're forcing the banks to do, you cannot go to the Fed window unless you lend out 25% of your book to the SMEs. Imagine that impulse, what that would have. This is the 80% of the economy who's had, you know, 1-2% of the credit total pool. And then all of a sudden, of course, corporate bond spreads is collapsing, which, you know, for the richest 1% would be a problem, but for the 99.9%, they couldn't care less, right? So we need to allocate, I mean, we need to have this conversation next year about how do we invest outside the listed market, because that's where your return is going to be. So it is actually my firm belief in you as an individual, Jim, that makes me call for that. I think the individual person is fed up. I think you are beginning to understand that you cannot just go online every day and buy, you know, yielding stocks, a CAPE at 26, whatever. You are paid, and that is my one last final note here. Every single study I ever read tells you one thing and one thing only in terms of investment. You are paid to take the liquidity risk. The reasons why that Greece trades at 5-6% 6 CAPE is illiquidity. So the real weighted price is actually 12 or 15. It is the liquidity of access in that market you are getting paid to take. So and that was happened with the endowment model and why that was so successful. Now the problem is with the world overflowing with money, the illiquidity aspect has moved further and further out the cycle. The only thing left is my SMEs. And that is exactly why you want to invest in the SME, because that's the only liquidity you have left in the marketplace. Does that answer your question, Jim?
Thank you.
Thank you.